And 3, 2, 1. Welcome to the show.
All right. Thanksgiving, or not Thanksgiving, not yet.
Like
Halloween weekend.
Spooky.
Always a good one.
Spooky at my house last night.
Yeah. Big party at your house last night.
Yeah, wasn't my party. Kids threw a Halloween party, and I went to the movies.
That is a good option, my friend. Good option.
If you haven't seen Black Adam, I'll give you my review. I don't go to a lot of movies. It was worth seeing, but it was odd because, like, I don't keep up with all the comic book stuff that well. Yeah. But I remember it from, when we were kids. But Marvel just seems to do such a better job. I don't know why, but because it's a DC comic thing.
Yeah.
It's really weird. And even my 11-year-old noticed it. She's like, yeah, Marvels are way better.
Yeah.
I'm like, I don't know why. It's The Rock. Like, how
does The Rock get involved in something that's not working, right?
Yeah, I think they're trying to revive it with, I don't know. That's my crystal ball.
Yeah.
But definitely worth seeing, though. It was fun. It was fun.
Might have to
I
check
haven't
that
been
out.
in a movie theater. I don't know. I did see Maverick in the movie theater, but I think before that, it had been pre-COVID.
Yeah, Maverick was a good one. You definitely had to watch the first one first.
Yeah. Some of these are just better on a big movie theater.
Sure. Yeah.
What you got for us this week?
Well, it has been quite an October, right? We got one more trading day left in the month, and we shall see what happens. But actually, one of the interesting stats for the month is that the Dow Jones Industrial Average, unless we have some kind of major collapse on Monday, Dow Jones Industrial Average has had the best October in history, amazingly. So first half of October was very tough, but the second half of October was pretty awesome. So what we're going to do is take a look at, if you were a subscriber to the site, what you saw when our alert came out on October 18th. I want to go through the C Fund chart of that alert so you guys get an idea of the kind of analysis that we do for our subscribers. Then we're going to take a look at a chart that shows how long historically it takes to get back to even, right? We're down 25%, whatever, on the C Fund right now. From a historical perspective, how long would it take to get back to even? And then popular request, Roth versus Traditional TSP, and then we'll look at the 3-year weekly TSP fund charts. Okay, so if you're a subscriber to the site, we did an alert back on October 18th, and this is what you saw. So let me just zoom in on that, and then I'll get my pen going. But you can see that little black tick above the blue 20-day moving average line, okay? It's kind of hard to see, but you can just barely see it. So here's where we were on that tick right there, and it was, a little before 10 o'clock in the morning. So we had gotten above, we gapped up in the morning above that 20-day moving average line. We were just right at that 50 line on RSI. We got above 0 on CCI, and MACD had crossed positive back here and was expanding upward on that day. Okay, and the histogram was pretty clearly positive. So that was in the morning. The close of the day, it actually reversed and came a little bit lower on the day, but that was the day the alert came out.
And that's just 4 indicators, right? There's a lot of technical stuff going on behind those indicators, but you wouldn't have to understand much more than up, right, to go, okay, at least this is something I need to be looking at.
Right.
Let's say you just did it at the end of the day, right? And you kind of looked at the day.
Yep.
You would at least get an indicator to yourself that says, oh, something's changing, right?
Right.
And that's the big takeaway. Now, of course, Jerry's looking at it every morning because we need to put an alert out before noon. So, of course, he's obsessing over it. Right. That's what you guys pay us for. But, again, we're an educational place, right? So it's getting you guys to see that if you saw that in a day, now that's a signal.
It's a buy trigger.
Yeah, it is. And it's okay if of course you want to make it that day, the as soon as you recognize the trigger, but life goes on if you didn't, right?
Right. So what happens if you made so what we do on the alerts is I'm moving, when I put out an alert, I'm saying where and when and why I'm reallocating within my personal TSP account, right? So what I put out in the alert is the risk reward ratio to this, right? Because if you got that day's closing price right there at 37.41, then if it got below, this low here at 3,500, you would get out, and that's the risk, right? The reward is that price comes up, to that downtrend line at 4,100. So if you don't do the alert, if you don't do the reallocation on the day the alert comes out and you wait and price comes up to, say, 3,900, which is closed on Friday, and you look at it and you say, well, can I still get back in? Yes, of course you can get back in, but now the risk reward has changed, right? You wouldn't necessarily wait. Your line in the sand wouldn't be 3,500 anymore, but you have a lot more risk to the downside before we have major support versus the gains to the upside. So that's what I hear all the time. Like, hey, I missed the alert, or whatever. Can I still get back in? And the answer is yes. It's just that you have to understand the change in the risk reward scenario based on when you're asking me if you want to get back in.
Right. And if you miss the buy signal, if let's just say you're still learning how to do this, which many of us are, and you miss that buy signal, all you're really taking into account is, and this is where you have to take fear out of it, and you just go, here's the facts. Facts are the risk's a little higher.
Yep.
So what does that mean? That means you've got to watch it like a hawk every day.
Yep.
Because you increased your risk reward, right? So now you can't kind of be lazy about it. You need to really be watching it. And of course, in this market and the volatility that's going on, you should be looking at it daily. You can do this weekly, no doubt at all.
Well, that's really the point of pointing this out is that we on the weekly update shows here, we do the weekly charts, right? And absolutely, if you apply the same exact methodology to the weekly chart, it's just that at some point you have to pick a day to actually make the reallocation.
Right, and make a decision.
To make a decision, right? And so what we do for our subscribers is drill down to the day and, intraday to decide whether or not we're going to actually pull the trigger, right? So anyway, we had this. So again, this is a 1 year daily chart, right? So each tick is a day. We got the top up here in January 2022. We've only had this buy trigger two. I took out that line so that we also had a buy trigger in here. So 2, 3, and this was the fourth time this year that we had it, right? So this one, it didn't fail, but it didn't get much higher than that 20-day moving average line, and then it rolled over. But the other two were the two primary bull or bear market rallies that we've seen so far this year, and then the one that we're in right now. Okay, so that's what it looked like on the 18th of October. If we fast forward to today, what does it look like? We got in right there. So we had been in the C fund, right, since right about there. I'm sorry, the G fund. We've been in the G fund actually since that gap down right there. So we've been in the G fund for quite a while. We didn't take these losses in the beginning of October, and then we did a reallocation to 25C, 25S, 25I, and we kept 50 in the G fund on the 18th. And so the market's rallied quite a bit. So the market's up quite a bit, and we're getting ready to go into November. We've talked a bunch about seasonality and years ending in 2 and in the decade, and what other bullish. The fourth quarter, after midterm elections tends to be really bullish. So there's a lot of tailwinds to this thing to keep on moving. So can we get up to that, 4,100 downtrend line? Yeah, we certainly could. There's still room to go on the RSI, and the MACD is expanding upward. So there's certainly potential for more upside. But I think at this point, it's definitely still a bear market rally unless proven otherwise. So anyway, that's kind of where we are right now. And that's what you would get if you were a subscriber to the site. Okay. So we've been almost, January, October, 10 months into this, what we're calling a bear market, from the top in January to where we are now. We're 10 months into this decline, right? So historically, how long would it take to get back to even? So if you're riding this thing out, right, you're like, forget it, I'm going to ride it out. I got plenty of time, or I'm not going to worry about it. The market always goes up, whatever. This is a pretty good chart I took from Wealthion. If you guys aren't watching that on YouTube, you definitely should. Great macroeconomists on there all the time, and some really good end of the week wrap-ups. So this chart is basically telling us all the way back to 1950, the number of days without reaching a prior high. Okay, so what it's saying is, how many days does it take to get back up to the prior high? So in our case, it's the beginning of January 2022. So here's 2022, right? We are a long way. We're the 75 bear market, it took, almost 2,000 days, 1,900 days to get back to even from that bear market. 2002, it took 1,800 days, right? 2009 took about 1,400 days. So we are just in the beginning stages. If this thing is going to turn into a long, protracted bear market, like we had back here and here and here, it's going to take a long time, years. We talked about it before, like they call it the lost decade. From the top in 2000, came down to 2003, back up into 2007 to do a double top, and then back down lower again into 2009. And it took until 2013, so 13 years to get back to even. So if this is going to be anything like that, just kind of keep that in mind as you think about how you're managing your TSP. Okay, so Roth versus traditional. A lot of people asking about that. So I use Investopedia for a whole lot of these shows. It's a really, really good resource, and it's a good summary of things.
Yeah, and it's peer reviewed, ish. I mean, I think that's probably the right terminology to use it like they do in the academic world. But somebody writes an article, someone else reviews it, and then there's a third step that I've forgotten. So you will see conflicting opinions on there, but mostly they're not necessarily one is wrong and the other one's right. It's just a different way of looking at it, which is what you have to do with a lot of this stuff. So, I'm just giving a little bit of a disclaimer there with Investopedia. The reason why we kind of go there is because it's not normally just one filter, one person kind of writing a blog post, and it could be whatever the hell they say. Right. Like, generally speaking, it's well reviewed, so that nothing is really crazy in there.
Right.
But if this Roth versus traditional, you might find a different slant on this if you read a different blog post within Investopedia, but not wildly different. Right?
In Investopedia, right. But outside of that, if you look at blog,
it's all marketing.
Right.
Yeah,
right.
And Investopedia is more focused on factual information, right? So they're not trying to sell you anything in that post. Right. Now there's ads at the bottom, but that's their revenue.
Yeah, definitely. There's a lot of opinion, and obviously, people post their opinions, but Investopedia tends to just do the facts, and it's balanced on both sides.
Yeah.
Okay, so Roth versus traditional. What's the difference? In this case, they're talking about an IRA. It works the same for us for TSP, so just kind of substitute. There are some differences, but it's specific kind of to whether or not you can do withdrawals and things like that in TSP. But in general, when they say IRA, just replace that with TSP. So a traditional IRA allows you to contribute a portion of pre-tax dollars, right? In 2022, it was $20,500. It's going up to $22,500 in 23, and the catch-up contributions go up to $7,500. So you can contribute a portion that reduces your taxable income for the year that you're setting the money aside for retirement. So in a traditional, the taxes are due as you withdraw the money, okay? The Roth allows you to contribute post-tax dollars, so there's no immediate tax savings, but once you retire, the amount that you withdraw tax-free. So here's I'm not going to go through and read all this stuff for you guys, but the key takeaways, right? And this is really the big thing that you kind of have to make a decision about, and it's all based on your circumstances. The key difference between Roth and traditional lies in the timing of tax advantages. In a traditional, you deduct contributions now, right, as you're contributing them every payday. You deduct the contributions now, but you pay taxes later on the withdrawals. In a Roth IRA, you pay taxes on the contributions now, but then you get the tax-free withdrawals later. Okay, that's really what this whole thing boils down to. Traditional IRAs function like a personalized pension. That's not really that important, actually. So here's the big one. Okay, whether you think your annual income and tax bracket will be lower or higher in retirement is really the key factor in determining whether you want to choose a Roth or a traditional. So if you are planning to downsize and you're not going to get another job when you retire, your tax bracket is probably going to be lower. And in that case, you're better off with a traditional. If you think your tax bracket is going to be higher, and you're contributing a lot to your TSP, so you're going to have a lot of money in there when you retire, and maybe you're getting another job or whatever, or you have other investments, if your tax rate is high, then when you withdraw from a traditional, that's going to up your tax bracket
because it hasn't been taxed.
Yet. If you had done a Roth all the way along, anything that you withdraw from that Roth is tax free, so it doesn't increase your taxes when you take it out.
Right.
So it really depends on that's really it. That's really what you need to figure out.
And fortunately or unfortunately, the best way to figure that out is to go talk to a financial planner, right? Somebody that can take your whole world, not just your TSP, your whole world, your whole financial world, and put it on paper. And okay, what's your goal? Like you said, if you're planning to, like us, we retired, quote unquote, and have every intention in making more money through either investing or businesses or whatever, right? I mean, we're not that old. We want to keep going.
Keep going. Yeah.
So that might not be the same scenario as one of our buddies who, moves off to Florida and goes on his fishing boat every day, and he's not working, and he's pretty much living off his TSP and his pension, or her, and that's a whole different scenario. And so, to Jerry's point in that article, it's what your world's going to look like after you retire, or better said, what's your world going to look like once you start taking your money out of the TSP?
Right.
Because you may not need to take it out, and you're going to continue on to do all these things for the next 20 years and not touch it. Let it grow. Hopefully you're following us and it really grows. And then all of a sudden you need it, right? So if that's what your plan is, at the end of the day, you have to have some sort of plan as to what your life will look like when you want to withdraw that money. Now, if you're already at that point, it's probably a little too late.
Right. It doesn't matter.
Yeah, because that's what I talk to a lot of people about. They're getting close to retirement, and they're like, "Oh, should I have done?" It doesn't matter. Like, You've been in a traditional the whole time. You're just going to have to make it work. So then what you do is you start, again, financial planner, a CPA, an accountant, somebody that can help you minimize or maximize the tax advantages you can get. Right. That's when it starts to get complicated.
Holistically, not just TSP. That's
holistically. And that's why I'm saying, this is where I'm having the pitch to go see a financial planner. A lot of times we kind of poo-poo, the regular financial industry because a lot of times they're just trying to sell you crap you don't need. And you can find that in financial planners. What I will say is a lot of independent financial planners now are in a position where they're just subscription-based, fee-based, and they're like, hey, this is a one-time thing, we'll do whatever, and they're not trying to sell you a bunch of other crap. And so that's what you want to look for. And those are really, unless you're good at doing it, that's really the only person that's going to be able to wrap your world into some sort of construct for them to go, okay, this is what you should probably be doing. And if you're at the end of your career, you're probably past that anyway.
Yeah, you could always start, there are some income limits, but you can always start a Roth, whether it's an IRA or if you're still an employee in TSP, you can have two accounts.
Right, you can have both. Yeah. And then that starts to get more complicated. But you need someone to plug in those numbers, and it's going to spit out and tell you what your tax implications are.
Right.
That's how it works. Usually there's software, and they plug it all in, and they go, okay, well, if this scenario happens, here's going to be your tax and what we could do to offset that. But you're not going to have access normally you're not building a spreadsheet to do that.
No.
So
I did have this conversation. I was up at Penn State a couple days ago doing a blended retirement system brief for those guys, and one of the midshipmen asked about the difference between a Roth and traditional, and for them, like, they're still in college, they didn't even know that they could start up a TSP, right? I mean, so for them, their contributions are going to be so small, it doesn't really affect very much their take-home pay because it's so small, right? because obviously if you do a Roth, you are getting taxed on the money before you put it into TSP. So you're either contributing less into TSP or you have less take home, right? However way you want to look at it. But if you're just starting, it seems to me a Roth is the way to go. You're gonna pay less tax on the front, and the money that does grow over time, because that was really the big focus I was trying to show them through a couple.
You're
of
done
different
paying
charts.
taxes on it.
Yeah,
so it's already been hit. So yeah,
as it grows, I mean, and time is your friend, right? So if you're really young and you're starting out, a Roth is pretty much, I would say, a no-brainer.
Yeah. And again, you can always stop contributing to that, keep growing it, and start contribute to two different things. I mean, you have to sit down and kind of think about what's your long-term plans, you know. Yeah. And again, if you know by the end of your career, they've usually changed.
Yeah, that's the hard part when you're young, right?
You don't really know.
When you're young, I think it's easy because a Roth is a no-brainer. If you're already retired, it pretty much doesn't matter. You have what you have. Yeah. If you're in the middle somewhere.
That's what starts to get a little bit more. Yeah. And that's where I wish people would get more engaged. I mean, I wish I had gotten more engaged at year 10 versus year 15 or 20. Right. And you just aren't. And then hopefully we're getting the word out to people that you got to get engaged, and it's not that hard to do. But anyway, just, a little plug for our financial planners out there. There are good ones out there that are, we have a few people. We don't really recommend anybody because we don't want to get in that business, but you can find them, Google them, and you can look up reviews or whatever. But there's some people out there that it's probably going to cost you, $500 or a couple thousand somewhere in there. But that's what it's going to cost to get an attorney to give you something too. Right. But it's worth it because that way you can get a picture of what your life will look like and or what you think it'll look like, and then make these plans. Because if you're, this is what's good is like when I have people ask me the difference or what should I do between traditional and Roth. It makes me happy because at least you're thinking about it.
Yeah, for sure.
Right? But then what I usually tell people is like, learn how to manage it properly before you worry about whether it's pre-tax or post-tax. Yeah. Because that's going to matter way more than the taxes. Right. Because there's a lot of ways you can get around Uncle Sam's taxes, but there's only a few ways you can grow your TSP.
Growing it is,
And I did want to say that the limits that Jerry mentioned when he was talking in the beginning are for the TSP, right? Not the IRA. The IRA is like $7,500 or whatever. But we were quoting but it was a little confusing because we're looking at IRA stuff.
Right.
It's
not IRA. Right.
Yeah, I didn't want people to think that, wait a minute, you can't put that much in an IRA. Like, no, he was talking about the TSP. So when we're looking at this slide, like he said, like Jerry said, take out IRA and put TSP. And it's going to be the same thing. The limits are different, obviously. But the takeaway is Roth versus traditional. You got to decide what your life is going to look like when you want to withdraw.
Yeah, that is the tough part. I mean, my life now isn't anything like what I expected it to be.
Right.
So
hopefully it's better.
But I'm not complaining. It's just not what I expected. Obviously, I had no idea I was going to be doing a little podcast business or whatever. right. I mean, it is what it is. But the good thing is whether you pick a Roth or traditional, at the end of the day, you're getting a tax break either on the front end or the back end.
Right.
You're saving for retirement, and hopefully you're learning how to grow it. And be on the right side of the market. And
I think that's a bigger key is learning how to manage it and grow it properly over that time, because at the end of the day, like Jerry and I do, like I hate paying taxes, right? Really? But at the end of the day, like Jerry reminded me, like, yeah, but we still got the money, so you got to pay the taxes. So you pay the taxes. Of course, we would like to pay as little taxes as we can. I don't mind contributing to the larger scale of thing. I'm just in general not a big tax guy. But with that said, at the end of the day, make sure you know how to manage it, your 401k, your IRA, your TSP, and then worry about what the tax implications are.
Yep, absolutely.
In order of priority.
All right, so we pretty much just covered everything that I was going to look at here. So it's go to the site. I'm not going to read through this whole thing. At the end of the day, the key difference is, like we said, both traditional and Roth provide generous tax breaks, right? It's a matter of timing when you can claim them. So anyone with earned income can contribute to a traditional IRA, which again, substitute IRA because for us it's TSP, and obviously you are earning earned income. Whether the contribution is fully tax deductible depends on your income Okay, a bunch of information in there that's probably going to be specific to you. Roth versus traditional has some differences in the required minimum distribution. There are some restrictions on pre-retirement withdrawals that are different in Roth versus TSP. Let's see. So here's the bottom line. Should I choose a Roth or a traditional IRA? It depends, right? Key issue is whether your income tax rate will be greater or less than the time when you begin to withdraw the funds from your account. That's the bottom line. If you think your tax bracket is going to be higher when you retire, when you start withdrawing the money, you want to start in a Roth. That's probably impossible to know for sure, so you're forced to make an educated guess. Factors to consider are your current tax rate and whether you think tax rate will be far higher in the future. So that obviously gets into a political discussion that I really don't want to do, whether or not you think tax rates are going to be higher in the future or lower. Okay. TSP fund charts. So we always end with these weekly, 3-year weekly chart. So I do the 3-year just so that we can incorporate the COVID crash we had back here. And each tick, right, each one of these ticks is 1 week of price movement. So this is the 20-week exponential moving average line, okay, in blue. You can see that when we get back above that 20-week moving average line, we tend to stay there, and we correct down to it and find support there all the way along, right? All the way along until we had that first break through it in January 2022. And then ever since then, yeah, we've gotten above it a couple times a little bit, but in general, it acts as resistance now instead of support. And so where are we right now? We had 2 really big weeks, and right now we are right back to that 20-week moving average line. So this is a time where you want to look at it and say, okay, I've been, let's say, in the G fund. We have pretty much a double bottom here at 3,600, and we've had 2 really strong weeks, and we're right back to that 20-week moving average line. So if this rally is going to continue and get us back up to new all-time highs, the first thing that has to happen is it gets back above that 20-week moving average line, right? If it comes up here a little bit and rolls over and gets back below it, we're probably continuing lower, right? Which would be in keeping with the pattern. And so when we say this is a bear market rally, that's what we mean. We get a few weeks of a rally only for it to peter out and roll over and go down to new lows, right? We're at the high, came down, came back up, couldn't make a new high, rolled over, new lows, came up, tested it, new lows, came up, new lows. So is that same thing going to happen, this time? I don't know. But at some point, we're going to get above that 20-week moving average line, and that really increases your odds because then the line can start to act as support instead of resistance. Okay. And in conjunction with that, when the relative strength indicator, right, the RSI down here, when we get above the 20-week moving average line, RSI gets above 50. So if RSI is above 50, you're in good shape. What happened right here in January? RSI ticked below 50 and price kept falling. And same kind of support and resistance levels. It comes up to 50 and rolled over, right? Comes up to 50 and rolls over. So we're approaching that 50 line right now, again. So this is how you kind of make decisions about it, right? You can say, okay, if I get a weekly close up here above that 20-week moving average line, then I'm going to get back into the stock funds, right? And if it closes below it again, I'm going to get back into the G fund. And so if you're looking at it on a weekly basis, this is the chart you would use. Okay. S fund, same kind of thing. All kinds of support back here at that 20-week moving average line until it broke through. On the S fund, it was in November last year. And then every time it tried to get above it, it hit resistance, right? Had a little overshoot here, and we're right back to that line right now. So we're at an inflection point, in a decision-making process. So what you should be doing right now is looking at it closely and going, okay, if it gets above that line, I want to get back in. And your risk, right, is that it got back above that line right there for 1 week, and that would be your buy trigger. And then the very next week it rolled over. And then the week after that, it closed below that line again. So you would have, if you got in to the S fund at the close of the first week that it was above that 20-week moving average line, maybe you got in right there. And you had one good up week, and then the following week it rolled over, and then it closed below the 20-week moving average line right there. So you were pretty much flat, right? You might have taken a little bit of loss, but you were pretty much flat. But for that possibility, had price continued higher, you'd have been in good shape. But it didn't. It rolled over. So you got out, and you got out flat. I mean, there's no guarantees for any of this, but we're right back to that same place, right? So either we get resistance here, and we roll over, or we get support here, and we go higher. And so how you want to position yourself for that is up to you and your personal circumstances and risk tolerance. But at least you have the information to make a informed decision. Okay, iFund, same thing. If you follow the U.S. dollar index, the chart looks exactly the opposite of this. It's going this way, to the same proportionality basically as the iFund. So watching the dollar is pretty critically important, especially to the iFund. But we had a big move this week, and we're still not up to that 20-day moving average line yet. And RSI is still pretty well below 50. So we'll see. So the risk reward here, again, this is your line in the sand, is 55. But price is butting up against that prior low right here. So $60 line is going to be pretty important. And then 57.50 up here. All right, hopefully that makes sense. F fund is one that everybody's watching really closely. It was a huge week for the F fund, but still it's so oversold. RSI isn't anywhere near. It's not even, up past that line is 30. So it's just barely above that 30 line. It's got a long way to go to get to 50. It didn't close at the high for the week. It's got a long way to go to get back up to its 20-day moving average line. And if it does get there, it's got resistance at that prior low. We'll see it if the stocks really tank. That the F fund is likely to really take off. If and when we get to that point, we'll talk about it. But right now, so far for 2022, the big problem is that this is bonds, right? Bonds and stocks have both rolled over sharply in 2022, which is why the retail financial planning industry is freaking out, because the 60-40 portfolio has not been working at all. And so since that's all we have in TSP is 3 stock funds, a bond fund, and a money market, the only safe place to be has been the G fund for the whole year. Minus these little bear market rallies that we've had. So that is all I got.
Questions?
Yep.
As usual, if you have questions, put them in the comment section wherever you find a video. Shoot us an email at support@growmytsp.com, and the support team will forward it to us if they can. If it's something personal, asking for investment advice or that kind of stuff, we're probably not going to answer it.
Yeah.
But
it's very tough. The Roth question is very personal. And so, if you Google around and you're asking the internet to help you make decisions about that,
hard,
really, it comes down to all you have to know is that you can either pay the tax now or pay the tax at the time of withdrawal.
And either way, you want to pay the tax when you're in the lowest tax bracket.
Lowest tax bracket, yeah.
That's the goal. And if that doesn't happen, don't freak out, because there's lots of other ways to kind of manipulate the tax code. Right. And that's what you hire a CPA for, or financial planner or whatever. So there are people out there that can help you, and it's worth the money if you find a good one.
Yeah, for sure.
All right, guys. If you like the show, share it with your friends. If you don't like it, share it with your friends anyway. Hope you guys have a great week. Hope you had a safe Halloween. And, Halloween's tomorrow.
Wow. Yeah.
It was last night for me. All right, see you guys.
See you next week.